Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to discuss my dividend growth portfolio, which just hit a major milestone, crossing $100,000 in total portfolio value for the first time ever. And as of market close, the entire value comes in at $100,621, and it feels amazing to finally hit that six-figure mark. And it just shows if you consistently contribute to your portfolio, buy strong companies that are expected to appreciate in value over time, you can hit some major milestones. And as I'm still in my early 20s, I have another 2 to 3 decades of investing, and over the longer term, I do believe this portfolio can grow into a large sum of money and create true wealth and financial freedom. And if you're new to the channel, please hit that like button and subscribe, join the community, and I'm the Gen Z investor, and here every single day, we talk about the stock market, going over different stocks you can buy and sell, we discuss any major market news, and of course we track the progress in every episode of my dividend growth portfolio, which you can see here is now worth over $100,000. I've been building this up over the past few years, and going forward, I will continue to contribute heavily every single month and let the compounding effect continue and accelerate over the longer term. And right now, we can see in just share price appreciation, not including my dividends received, I am up 22% or over $17,000 in market appreciation. And I'm a very conservative investor. I only put my capital into high quality, blue chip dividend paying companies that have a strong, consistent history of growing revenue and cash flow every single year. And my portfolio is an example to show you that even if you want to buy boring companies that provide you with growing passive income, you can still see some nice long-term share price appreciation. And if we take a look at my holdings, these are all companies people know and use every single day. And throughout this video, I'm going to share with you my sector diversification, what are my top stocks overall, and what I plan to buy and sell over the upcoming years. And if we take a look at an overview of my entire financial freedom portfolio, we can see the value of $100,000 will provide me with an annual income of $2,219 per year. So of course that gives me a current portfolio yield right around 2.2%, and my yield on cost is at 2.77% overall, and my beta comes in at 0.87, so I'm a little bit less volatile than the overall market. So right now, if you take a look at my stats for a dividend-based portfolio, the current yield and the yield on cost may seem very low. But because I'm only in my early 20s and I have the next few decades to invest, I'm focusing on long-term total return, which includes long-term dividend appreciation as well as share price growth over the next few years as well. So I don't need to chase any high upfront yields of 5, 6, or 7% because I don't need the income right now. I'm not living off this portfolio at this current point in time. I'm in the building stage, so I want to deploy my capital to the companies who may have a starting yield that's a little bit lower right now, but I believe will consistently grow that payment for long into the future. So I'm not focused on high income right now. I'm a dividend growth investor focused on total return in buying solid companies with a long dividend growth future up ahead. So right now you can see my annual passive income does come in at over $2,200. So without working, I'm making this much money every single year coming into my portfolio from my existing positions. And over the next 30 days, I have a bunch of passive dividend payments flowing into my portfolio. Apple, AbbVie, and Costco pay out their dividend next week. Then of course we have Procter & Gamble, Royal Bank, Visa, and many more filling out over the next 30 days. So we can see that every few days, I have passive income flowing into my brokerage, which is exactly the goal of this portfolio over the long term. And if you're new to the channel, that's why I keep my portfolio named as Financial Freedom, because the long-term goal of my investing is to one day achieve true financial freedom where I no longer have to work for money. My investment portfolio, made up of different real estate and holdings in the stock market, will provide me with enough income every single month to cover all of my bills, and I can live my own lifestyle without having to work. So I keep my main goal of investing over the long term as financial freedom, and that's my portfolio's named that, and it's shown in every single video on the channel. So we can see over the next 30 days, a lot of cash flow is coming in, and over the next year, like we saw, we're expecting over $2,219 of money flowing in this portfolio, and we can see a breakdown of it every single month. And of course, because companies pay out quarterly, there is fluctuation month over month, but we can see May is the largest month, coming in at $252. And why I choose to hold dividend growth companies is because without having to do any work or buy more shares, my income continues to grow year over year. And if we take a look, Pepsi just raised their dividend by 5%. This is one of the larger holdings in my portfolio, and my annual passive income just got a raise of 5%, and I didn't have to do any work. And if we take a look throughout the month of April, a bunch of companies declared dividend increases. Apple, which is my largest position, making up around 13% of the entire portfolio, raised their dividend by 7.3%. And other companies like Johnson & Johnson raised their dividend by 5%, Southern Company, a strong utility brand, raised by 3.1%, Costco, a nice major 13% dividend increase, and of course Procter & Gamble also announced a 10% raise as well. So a lot of strong companies that I own in my portfolio that I'm sure everyone knows about and uses their services just provided me with some nice dividend raises. And at this current level, around 80% of my dividend income is considered safe and 21% is considered borderline. But if we take a look at the three companies that make up 21% of my overall income and is considered borderline safe, it makes up of Bank of America, JP Morgan Chase, and AT&T. And I'm going to share with you the reasons why I'm not worried or expect a dividend cut to come from any of these companies. First, with AT&T. Although they make up a smaller position in my portfolio, because of the natural 7% yield they have on the stock right now, it makes up around 15% of my passive dividend income. And although they do have a lot of debt on the balance sheet, which is somewhat worrying, the CEO just came out last month and announced that the dividend will not be cut in order to fund future growth. And from their Q1 2021 earnings release, their current dividend payment only makes up 61% of the company's quarterly cash flow. So they still have 40% of their cash on hand at the end of the quarter to reinvest, pay down debt, and continue to grow the company. So I'm not expecting a dividend cut to come from AT&T anytime soon. And then of course, we have the two largest banks by market cap, JP Morgan Chase and Bank of America. And combined, they make up around 6% of my total dividend income. And we can see the reason why I'm not expecting a dividend cut is because these two banks have just announced their start 2021 major share buyback programs. JP Morgan Chase will be buying back $30 billion of their stock, and Bank of America will be buying back $25 billion. These companies, if they were in a dire financial position, would not be buying back $25 to $30 billion of their own shares if they could not maintain the dividend. So that just shows that these executives in these two big banks understand their dividend payment, they know it's sustainable over the longer term, and then they can still afford to pay out that dividend while returning excess capital to their investors in the form of share buybacks. So I have absolutely no worry about this borderline safe income because right now these three companies are all showing good signs of health, and I believe the dividends will remain stable and grow over the longer term. And right now, if we take a look at the expected growth of my dividend income, this is forecasted by Simply Safe Dividends. I did not do this calculation, it's not my own numbers, and I have to admit, these are very optimistic total expectations. And right now they're predicting that if I remain stable and my dividend growth rate for this portfolio stays around 7% and I reinvest all the dividends, which I always will do, it will provide another 3% boost in going forward from my current $2.2 thousand over the next 20 years to 2041. My current income without buying any more shares will grow to over $14,000 with consistent dividend growth and reinvestment every single year. I do believe that is extremely optimistic, and I'm not forecasting that growth in my own personal projections. But for me, I believe if we take the 7% growth rate, ignore the 3% boost, even though I will be reinvesting the dividends, forecasting over the next 20 years that the current income will grow to 8.5K, I believe to be much more reasonable. And even at that growth rate, turning my $2.2 thousand in current passive income all the way up to 8.5K per year only in the next 20 years without having to do any of my own work would be absolutely incredible. So I'm not going for the fully optimistic view because I think too high expectations can really let you down over the long term. So if I remain conservative, go with the 7% growth rate to actually keep at the base rate of my dividends, I think that'll be a very achievable goal over the longer term. And of course, because I do contribute my own capital every single month, this will accelerate much faster, but I did not include that so we can keep it fully transparent. And now we're going to jump over and take a look at my personal dividend tracking spreadsheet that I created to list out all my holdings and my projected income and track the performance of the portfolio over the longer term. In this spreadsheet, everyone has access to it for absolutely free using the link in my description. I will never charge you to see my holdings. You can have a live update whenever you want, and in the link of every single video I post is directly related to this spreadsheet. So you can see I have all of my holdings laid out, how many shares I own, the current market price of one share, the market price times how many shares, of course, will give you the total market value of that position. And then I have how much of a holding it is in the portfolio. So we can see Apple is my largest holding, making up around 13%. And second is Microsoft with around 11% of the overall value. And of course, I also have all the dividend information, the current yield on the company, and how much annual income each individual holding will pay me over a 12-month span. And of course, if we scroll down, we can see the total appreciation of over $17,000 and the total value that now sits above $100,000. And if we take a look at my sector diversification, right now I am heavily weighted to the tech sector, but I do not believe I'm overweight whatsoever. Right now, 35% of my overall portfolio is weighted toward tech, and of that 35, 24% of it is made up of just Apple and Microsoft. They are the two largest companies in the S&P 500, and I believe they're two of the strongest brands in the entire world. Although they already make up a large portion of my total portfolio, I will still continue to buy more and have no plans of selling anytime soon. And then, of course, some other big sectors I own are consumer staples, financials, communication, some healthcare, some consumer discretionary, and of course some utilities and a little bit of cash. And right now, we're going to take a look at all my holdings individually just to give you a brief overview of the big names that I hold. And starting off with the tech sector, we have Apple, Microsoft, Visa, MasterCard, Broadcom, and Taiwan Semi. And of course, these are kind of spread out across different type of tech names. Apple and Microsoft, we've already discussed. Then I own Visa and MasterCard, and having these two companies in your portfolio controls around 80% of the total debit and credit card market, which has extremely high margins. These companies are very profitable, and over the long term, I believe they will continue to grow. And then I also own Broadcom and Taiwan Semi to get exposure to dividend-paying companies in the semiconductor industry. And then if we move on into financials, I own JP Morgan Chase, Bank of America, Royal Bank of Canada, and Toronto Dominion Bank. So I own 4 different banks for the reason that Royal Bank of Canada and Toronto Dominion Bank are the 2 largest banks within Canada. Then of course JP Morgan Chase and Bank of America are the 2 largest within the United States. So right now, I own the 4 largest banks within North America. These companies have great balance sheets, strong financials, and I do believe in the financial sector long term. I love the passive dividend income that they produce, and owning these companies has provided me with great returns. We can see in my JP Morgan position, I'm up 38%. Then I'm up close to 45% in Bank of America, 27% in Royal Bank, and over 43% in Toronto Dominion Bank. So even for some boring companies like the big banks, you can still get some very nice returns with dividend yields right around 2 to 4% per year as well. And then of course, if we move on, I have my communication holdings, which are AT&T and Verizon. These are some of the blue chip companies in the sector that provide extremely high yields for that consistent passive income every single year. And as many dividend investors do, these companies provide you with that high current income, but a little less share price appreciation over the longer term. And then if we move on into healthcare, I own AbbVie, Johnson & Johnson, Merck, and Pfizer. So 4 names in the sector, some of the strongest blue chip dividend paying companies, and I have a lot of diversity. Johnson & Johnson, a blue chip name that's a dividend king, growing that payment for over 55 consecutive years. And then AbbVie, a younger company, but a lot more fast appreciation. And in the 7 years that they've been a spun off individual name, their total dividend has grown over 200%. in only a 7-year span. And then, of course, some more boring names like Merck and Pfizer to provide more diversification across the healthcare sector. And then my 2 consumer discretionary names are Home Depot and Lowe's. These 2 companies dominate their industry, and I don't see any competitors knocking them out of the number 1 and number 2 position in the home improvement space. And right now, even as we shift to more e-commerce society, I think going in person to a Home Depot or to a Lowe's to pick out your products for your different projects will always be part of consumer behavior, and their in-person retail will continue to be very strong. So those are my 2 consumer discretionary holdings. And then if we move on into my consumer staples, I consider Costco a consumer staple along with Pepsi, Procter & Gamble, and Kimberly-Clark. So again, 4 companies in this sector, Costco being one of my favorite retailers to own, Pepsi, one of my favorite food and beverage companies, then of course Procter & Gamble and Kimberly-Clark that pretty much dominate the shelves of every single store all across North America and in the international markets, owning some of the best-selling and number 1 brands in all the consumer space. So right now, these 2 companies provide great diversification across all the consumer products we use every single day. So again, boring companies, Costco, Pepsi, PG, K&B, but they all provide me with nice passive income, and I believe will all be operational with growing revenue and income for many years to come. And then of course we have my utility sector, which is made up of Duke, Southern, and NextEra, 3 of the strongest companies in that sector. Duke and Southern, more traditional names with higher yields, and then of course NextEra, which provides a lot of share price appreciation, a little bit lower yield at the starting point, right around 2%, but they also have a lot of exposure to the renewable sector. So that's kind of how I spread out my utility holdings. They aren't very large in my portfolio, but I like having exposure to that industry for the consistency of the cash flow that comes in every single year. And then finally, my last holding is Canadian National Railway, and that's the only industrial stock that I own in this entire portfolio. Small position, one of my smallest with a market value of only $1,300, but I like having the exposure to the railroad sector. And for example, Bill Gates and his foundation are one of the top individual shareholders of this company. He's been holding for the long term and believes in this brand in that sector going forward. And overall, of course, we do have a little bit of cash sitting in at $2,783 at this current point in time. So that's kind of how my portfolio is diversified. You can see I'm spread out across many different sectors, a ton of different holdings, but I'm sure you've all recognized every brand that I own. I don't pick anything too speculative. I like the companies that have those consistent operations, can generate more and more revenue over the long term. They have pricing control, high margins, and sustainability, even with new entrants into their markets. So that's kind of how I have my portfolio spread out. I'm sure it's not the best portfolio ever created, but I created it for me. Everyone has their own personal investing style. Everyone has their own journey. People are going to hate my portfolio. Some people are going to love it. It's everyone's own perspective on what they want to do with their own money. So please let me know down in the comments your opinion on the market. Do you think it's going to continue to climb higher? Should you go dividend stocks versus growth stocks? Let me know your thoughts. Do you like my portfolio? Do you hate it? Do you have companies I should add to it or sell out of? Let me know your thoughts down below. We are a community, and I want to thank you for watching this video to the end. This was just a short recap of my overall portfolio because we just crossed that massive milestone of $100,000. So I really want to thank you for watching. Thank you for supporting the channel, and I will see you in tomorrow's video.